about now. Oh, thanks for starting the recording, Jeff. Well, welcome again, and a very special welcome to any of our New York City IRS Forum attendees who might be joining us this evening. And it is my great pleasure to introduce today's speaker, Erinne Perry. Erinne is an EA.
You froze, Phyllis.
I'm sorry? What'd you say, Jeff? Oh, maybe not. Erinne is an EA, a CPA, and a certified bookkeeper. She describes herself as a woman of faith, a devoted wife, mother, entrepreneur, and college professor who credits both her success and resilience to God's grace and principles instilled by her late mother. With over a decade of experience in accounting, bookkeeping, and taxation, Erinne has built her career not just on the numbers, but on a calling to serve by helping individuals navigate accounting and taxes and empowering entrepreneurs to manage their financials with clarity and confidence. Erinne is passionate about equipping both clients and students with the tools they need to succeed. Erinne also serves as a director at large on the NYSSEA Board of Directors, and this is her NYSSEA webinar instructor debut. So Erinne, thanks for being here, and the floor is all yours.
Good evening, everyone. I hope all is well. Thank you, Jeff, and thank you, Phyllis, and the rest of the team. Good evening, everyone. Hope all is well. For those of you that was able to attend the IRS forum today, I pray that you guys had a good time. We're going to jump right into the webinar for today. So as you guys see the title, Accounting Fundamentals for Tax Professionals. So I want to make it very clear that today is not about teaching you how to become a bookkeeper. Many of you probably already have a background, you already have clients, but the key thing is
Okay, I'm not sure you can hear me, but for some reason, my screen is frozen.
Can you all hear me?
I'm going to have to try to switch to another computer.
Yeah, we can hear you, Erinne, and I don't see that anyone else is having any problems. So I think you can continue, and Jeff will come back on another computer.
Yeah. Okay. All right. Perfect.
All right.
All right.
Thanks.
Perfect. So again, it's not about teaching you the basics of accounting, but the goal is for us to approach business clients differently with the knowledge that we possess as tax professionals. Typically, we're often brought into the activity after things happen. So after the client made the decision to purchase an asset, or after they made the decision to take on an independent contractor position and things of that nature. So the key thing that I want everyone to understand is that as tax accountants, the key thing is we have the understanding to be able to help businesses make the right decisions. So just by, in the chat, you guys can put it, how many of you have ever prepared a tax return where the numbers were technically correct, but something still felt a little off? So you could put me in the chat. Maybe the revenue seemed a little unusual. There was a lot of money that was being taken out, or there were a lot of expenses and, you weren't necessarily sure because you didn't have the detail if all of the expenses were actually business related. So we've all pretty much been there. This course is ultimately about my journey. So Phyllis shared who I am. I'm Erinne Perry. I'm both a CPA, an enrolled agent, and a certified bookkeeper. And although those credentials look great, the reality is that I was trained in accounting. I learned taxation, but it wasn't until I entered into Big Four and I started working with business taxation, I understood the importance of bridging the gap between accounting and taxation. Nobody taught me that. And then for a long time, unfortunately, and even today in school, as a college professor, I see that they're typically taught as a separate discipline, when in all reality, when you start to deal with business clients, you cannot separate the two. All right, so as far as our learning objectives for today, by the end of this session, I expect that you should be able to identify accounting patterns in business financial records that might affect the federal tax return preparation, or sometimes it might require additional inquiry. My goal is that by the end of this, we already know October 15th is coming, taxation is not just about being reactive. A lot of times we have clients and the deed is already done. As accountants, we know what a closed transaction is. 2026 finishes, 2027 now comes. There's not much that a client can do for individuals. But when we're dealing with business clients, we can now be more proactive and help them once we ask the right questions. So again, today's webinar is ensuring that there's a shift in mindset. We're going to apply a method that I came up with, the reconcile method, to investigate the differences between accounting records and tax reporting, ultimately helping us to identify any book to tax issues. We'll evaluate some common bookkeeping and classification issues for potential federal tax consequences, because as we know, if we deal with business clients and they try to DIY their accounting, there's a lot of things that we uncover. Or I'm not ashamed to admit, when I first started in my career with business clients, there were some areas of accounting that were a little sticky. But as you grow, you come to realize that all of these accounting decisions can ultimately have a tax consequence, whether it's taxable income, non-taxable, whether it's a deductible expense or not. This is where we sit as tax professionals with this information knowledge that we can ensure that our business clients truly understand what can and can't be done. So we'll determine whether we should prepare, adjust, further investigate, scope to determine if there's any additional work. And the great thing about being an entrepreneur, we can decide to refer the client. We can decide that this is out of scope and we don't have to work with them. And then the last objective is we'll use financial information to identify facts that require further analysis before we can provide any tax planning recommendations. So I want to be clear, some of you have been preparing taxes longer than I've been alive, and I'm aware of that. So again, the key thing, not here to teach you how to prepare a tax return, but the key thing is to challenge how we approach those tax returns. So as mentioned, some of you might have an accounting background. Some of you might have just taken the enrolled agent designation exam. And when you are dealing with individual clients, it's simple for the most part. It's more so compliance. You receive the tax forms and you report them accordingly. Now, when we're dealing with businesses, that's where an understanding of accounting is very crucial. If you are an accountant and you have that experience, or maybe even after you've taken the enrolled agent exam or started to work in taxation, you decided, I want to understand taxation. Most taxation courses, they teach debits and credits, and they teach the financial statements. Tax courses, on the other hand, they'll teach you the Internal Revenue Code, the regulations and returns, and obviously you'll also have to learn the state equivalent. Two disciplines, two tracks, and depending on the course you take, they're rarely ever connected. In the business world, however, we know that they can't be separated. A business does not operate in silos. Every decision that they're going to make is going to create some type of accounting entry, and then that is obviously going to have a top tax consequence. So the gap between the two, the knowledge that we possess as tax accountants, this is where there's a great opportunity, but the key thing is if we know how to bridge it. So the tax return, as we know, it's done on a retrospective kind of basis. 2027, January is going to roll around and we're going to file for 2025. The numbers are going to help us understand why, but understanding why and what happened, that's ultimately going to determine the decisions that can be made and if we can actually allow tax planning or provide rather tax planning for our clients. So as we see here, it's in a sequence: the accounting, financial information, tax, business decisions, and plannings. When we're building a house, the foundation, as we know, is the most important thing. So if the accounting, the bookkeeping is shaky, everything else, the financial information, the decisions and things of that nature, all of those things, they will not stand. So we think about it in our everyday life. A simple example, let's say you have your bank account and you have a check that is going to be electronically withdrawn. You, let's say, have $500 in your bank account, but the check is going to be taken out for $700. So you open your bank account and you decide, hey, I want to go out to eat or hang with a friend or something of that nature. You forgot about that $700 check. So now your account is eventually going to be negative. So you made a business decision off of a faulty foundation. It's similar when it comes to accounting. You cannot, as a business owner, make the correct decision unless you have an accurate understanding of what the numbers are telling you. So this is the professional shift. It's not just about processing information and filing returns, but now how can we interpret this information for our business clients? Because this is something I've learned in the profession. Sometimes clients, they don't understand that there's a difference between compliance, filing the return, and planning. So it's very important to understand the difference between the two. So here we have our first question. And, you know, there's no necessarily right or wrong answer, but we're looking at what's the best answer. So we have a client's tax return is accurate and it's filed on time. What does this alone tell you? A, the client's business is financially healthy. B, the financial statements are accurate. C, what happened, but not necessarily why or what it means going forward. Or D, no further review is required. So this is your client. What do you think? All right, perfect. So I see a few cheat C's in the chat. That's correct. So just because a return was accurately and timely filed, it does not necessarily mean that that tax return is correct. There's plenty of times where I found so many things dealing with clients. They would send over the financial statements and they send financial statements on the cash basis, but then when you see the tax return, it marks off or checked off that they're using the accrual basis of accounting, and you can't reconcile the two. There's an issue. So that's why I started to work on this reconcile framework. So as we move through the financial statements, bookkeeping, book to tax differences, the key thing, we're always going to be returning to this one thought process, not just what is the answer, but how do I ask the right professional questions for this client? So reconciliation is familiar to us. As accountants, we reconcile the bank accounts, the loans, credit cards, and things of that nature. As tax professionals, when we start to deal with corporations and S corporations, we need to make sure that we're reconciling the difference between the book income, taxable income. When it comes to financial information, when we file that tax return, we anticipate that in the event that, let's say, the IRS or a state agency decides to audit these books, what was reported on a tax return is substantiated by the financial information. So we reconcile that. And then lastly, business decisions. They must reconcile with the financial reality. Sometimes, there's a lot of clients, there's a lot of information being shared on social media with just purchasing a vehicle. You can write it off. But the reality of the matter is, if the business does not even have enough cash flow to pay their monthly expenses, that deduction ultimately would hurt them. So having a clear understanding of the numbers is how we position ourselves to really serve our clients in the best way. So the reconcile method, it's not just a checklist, but again, it's a way of thinking. So we read, what are the numbers telling me? I believe that's why I love accounting so much, because I love to read books. But with accounting, it's like reading a story just using numbers. So what are the numbers telling me? Because sometimes we might see net income of $100,000, but that doesn't necessarily equate to $100,000 in the bank account. So now I need to go read the cash flow statement to get a better understanding of what's happening. Question: what does not make sense, or what deserves clarification about this? We'll go back to the same example. There's $100,000 of net income, but there's only about $30,000 in the bank account. Why does this not make sense? If I compare the two statements, check to see the transactions and things that happen during the course of the business, then I can now explain to clients. Because a lot of times, and I'm sure that there's many of you that can attest, that you have clients and they say, I don't know what's happening. We file a tax return for them. They owe self-employment taxes, but they are feeling as though maybe they're drowning because they're not seeing the money. We're in a position to help them understand what's going on and asking the right questions, investigating. What do I need to verify, if anything? Some clients, unfortunately, especially for those that might just be starting out, maybe they're commingling funds, we want to verify and investigate. Again, we're not auditors, but we also want to ensure that we are encouraging our clients to adhere to the law. So investigate to ensure there's integrity. Connect. How does the accounting reality affect tax? Connect. How does the accounting reality affect tax? And then from there, connecting. We want to determine, what is going on. We identify what risks and opportunities exist. So even as we're preparing to close out October 15th, this is a great opportunity to start to look at some clients, mostly business clients. Individual clients, we know that there's a bit of nuance because there's not a lot of planning opportunities depending on their situation. But for business clients, we can start to look at the prior year. When we file the prior year tax return, if you're involved in their bookkeeping, this is the prime opportunity to start proactively providing methods to your clients. So the professional mindset, we're already trained in the compliance mindset. What happened? The client worked for ABC Corporation for the year. They received a W-2 for $100,000. All of that information is on the tax document. All we need to do is input it into the software. So we're familiar with what compliance is. Interpretation. What does this information mean? Because this individual earned $100,000 and according to their filing status and deductions, now this means they owe Uncle Sam in their respective state XYZ amount of money. But where we provide the real value as tax accountants is now we're planning. Well, what can happen next? Does this client want to take money out of their IRA? If we're dealing with an individual, maybe they want to sell a home, start a business. When we're dealing with business clients, that opportunity is more so there as compared to an individual. So what can happen next? A client calls you, they say, hey, I'm thinking of purchasing a $20,000 piece of equipment. Would it make sense? I'm sure many of you might have had that in your practice. Same for me. We're winding down the year. Clients, they want to know and understand, okay, what decisions can I make before the year is out that's going to help me when I file my tax return next year? And then lastly, advisory. So once we merge the two, the planning and the advisory, what should we consider? So none of these levels replace the one before. We need compliance. But when we understand the business that's behind the tax return we're filing, that's where we have the ability to build on compliance and we can provide deeper value to our clients. So this is just a quick little depiction of the tax return. So the return, that would be like the rear view mirror. As we know, we're looking in the past, what happened in the prior year. It's accurate, it's essential, but it's backward looking. We know what a closed transaction is. That means that the deed is done, there's not much wiggle room, versus an open transaction. This is where we're looking for the financials. They'll help us understand what's happening and what may be coming next. And this is where we have the opportunity to be strategic as we're working with our clients. So as a tax professional, if you're not already doing this, the best business tax conversations apply both of these principles. We're looking backwards at what happened, but also looking forward. This is what can be done differently next year or next quarter, depending on when you're working with your client. So we're going to meet Maria. She's a client. Maria owns a growing consulting business. She's organized, she's confident, and she's been using QuickBooks for 3 years. She finds you online. She says, you know, my books are clean. QuickBooks says everything is reconciled. I just need my tax return done and I want to pay less taxes. This sounds like most business clients. They assume, unfortunately, sometimes that they are accountants and they know what they're doing. And then it's not until you get into QuickBooks that you realize that accounts were set up for asset accounts as bank accounts. You know, I used to work with QuickBooks in the cleanup department, and I've seen a plethora of things that have happened when individuals try to do accounting by themselves. So when we finally get into books, those of us with the knowledge, we see unusual revenue. Sometimes it's overstated or understated, or the accounts are set up wrong as mentioned. The classifications are incorrect. Sometimes personal expenses, they're baked into some of the expenses. So you need to take a deeper dive. Owner distributions, sometimes those are classified as expenses when in fact their equity reduces distributions for the owner, depending obviously on the structure. Loans, we also need to account for those. Is this actually a business loan? If it's, you know, an S corporation, now there are more requirements that we need to account for. Is this actually a shareholder loan? Are there documentations, contracts in place? Is there an interest rate? So all of these different things as we start to look, and sometimes it's not necessarily that the clients are trying to get over on the IRS. Sometimes they honestly don't know. And that's where we come in and we can assist them. Because as we know, the return, it doesn't tell us everything. We'll see on the return, we're working with a new client. Typically, I'm pretty sure all of us, we ask for the prior year tax returns so we can review and we can see what happened as we start to scope the engagement. We'll see the revenue, we'll see the net income, and it looks clean. Everything looks okay. But we have to ask ourselves, does the revenue reconcile to deposits? A lot of times, especially if they're dealing with third-party processing vendors, they only account for the net. not the gross, which is incorrect. So on the surface, to the client, in their mind, everything is correct because revenue ties to the net income, but they're missing the expense for the merchant fees. And per the rules, it needs to be gross income. What changed from last year? Maybe in the prior year, they made $1 million in revenue. Net income was 300,000. So these are the things that we start to explore. Are the classifications appropriate? What about debt? Are there large distributions? Any unusual owner's activity? All of these things, as we have a better understanding of accounting and the numbers, we can better advise our clients. So reading the financial statements. Again, it's not just about memorizing financial statement definitions. I'm sure everyone here can call off the main financial statements and their purpose. But again, the purpose of the financial statements is that they're telling a story using numbers. And because they do, the numbers should have a relationship. And if those relationships don't make sense, then that means that there's an error somewhere along the line. So I know a lot of you have decades of pattern recognition. Some of you, might already be working and doing this type of work with your clients. What's the first thing you typically look for when a business client in particular hands you their books? And I'll look out for some responses in the chat.
Meanwhile, we're going to launch a polling question as well. So please look for that on your screens.
Perfect. All right, so Stephen said to check if there's no basis reported. All right, anyone else? So you just have a client, they called you, large expenses in relation to their income. All right, we'll take one more. Personal expenses mixed in. All right, perfect. And Daniel, that's a great one. But what if the client only gives you just the statement, not necessarily the details? So this is where we get the opportunity to take a deeper dive to see what's actually happening behind the scenes. Because again, a lot of times when clients, they're doing the books themselves, some might have bookkeepers, which is great. But unfortunately, sometimes even the bookkeeper, and sometimes, unfortunately, even the CPAs, the accountants, those of us that should know what we're doing, sometimes our foundation of the accounting basics are shaky. All right, so we have that last polling question. Okay. All right. And Karen pointed out large office supplies in a mechanic shop, categories that make no sense. Perfect. We're going to touch on that, the chart of accounts, which is also an indicator that something's wrong. So reading the income statement, we already know what the income statement shows. The income statement, the profit and loss, P&L, revenue minus expenses. But this is where sometimes a lot of the issues start. We know that when we're preparing financial statements, this is the first statement we prepare. We want to double check to confirm, was all of the revenue recognized during the period? Depending on the nature of the business, we know that if the business is reselling items, we should see cost of goods sold. We should see cost of services. If they're a service-based business and they decide to follow that setup for the chart of accounts. But for most businesses, typically if it's service, we wouldn't see inventory. So sometimes you see a lot of different things when you're working with a business client that indicates, maybe should I pull away from this engagement? Do I need to take a deeper dive to ensure that this engagement is going to fall within scope? Because I'm pretty sure, all of us in this room, we work pretty hard to get our license. You don't want to lose it. But sometimes these small oversights, just pushing things under the rug. Many of you probably have dealt with audits before, and audits are definitely no fun. So if we do things right the first way, typically it can help to prevent an audit in the future. So checking for things like gross profit margin, operating expenses by category, as Karen pointed out, even checking just the titles, because remember, when we're filing the tax return, in such case, where we have to input those other expenses, who knows, maybe those things can be picked up with the diff system, because some of the expenses or the titles, don't necessarily match the industry. So it's also very important to look into those things. I like that, Karen. You have to pass the spell test. All right. So what the tax professional asks, good tax professionals, we're going to ask, okay, is the revenue consistent with prior years? Or not even asking, being proactive and starting to look at our business clients and see what additional value we can provide for them. Because I'm pretty sure all of us, we would like more time and more money. If you would like more time and more money, please put I in the chat. I would put I myself. I'll be the first to put I, right? So as we start to expand on this type of expertise, this is where we can now provide more value to clients and start to bring in more money. So is revenue consistent with prior years? We can start to look at those things. Why are there changes? Is there anything that the business can potentially do to start bringing in more revenue? We can now start to help them understand those things and start to think about those things. Are expense categories reasonable? That's another thing. As Karen pointed out, I believe, with the mechanic shop, the categories are incorrect. They don't necessarily make sense. Or sometimes it's because personal is also mixed in with business. A key one, interest expense. They're deducting the full payment when only a portion should be allocated to interest and the rest to reduce the loan balance. Does the gross margin make sense for this type of industry? What looks unusual? So we know what the income statement tells us, the net income or net loss, but as a practitioner, we should start to look at it differently. What does it suggest about the reliability of the tax return? If we follow this right now and the IRS decided to audit this return, can the position be substantiated? And as we know with the balance sheet, we have our assets, our liabilities, and equity. As we just mentioned, when it comes to the interest expense, if a client is not fully understanding the principles of accounting, the net income is now understated. The liability was understated. Now we run a potential risk of being audited, right? Being held to the professional standard. So understanding how all of these things work, again, not to be, the master accountant, but understanding the relationship, the interrelated relationship of these financial statements. So we have our assets, cash. A lot of times I see, and sometimes the account balance actually is negative, but there are situations where the clients set up the accounts incorrectly. And there's been times where I've looked at financial statements for new clients using the data. It didn't tie to the financial statement. It didn't tie necessarily to the tax return that was filed. So you want to look at these things: cash, receivables, fixed assets. What does the business own, and is it reasonable for this type of a business? If they are cash only, why is their accounts receivable? Maybe they are a hybrid business, but maybe they're not. They're coding these things incorrectly. Liabilities, we want to make sure that the loans and the payables, everything is essentially accurate. Because in the event that the business decides they want to go and get a loan and all of these things, this is where we're in the position to make sure that it is accurate, so the bank has the right information to ultimately make that lending decision. Equity. Now, when it comes to owner's contribution and retained earnings and things of that nature, someone pointed out, with the categories not necessarily making sense, the chart of accounts. And this is something simple, very simple. I would implore each of you to just look at your clients where you actually are doing the bookkeeping for them, right? Some clients, they're hands off, where they just want you to do a very high level check. Some clients, they might want you to do the full bookkeeping. You are in a position where something is simple and value add as just tailoring the chart of accounts, making sure that the chart of accounts are in the proper alignment. You might have been doing their books for a while, but you can let them know, hey, just based on industry standards, this is a value add that I could potentially provide to the company. So as it relates to the balance sheet, the key thing again is, what does the balance sheet suggest about the reliability of the return as well as the owner's behavior? When we're dealing with the bookkeeping for a lot of these clients, we see a lot of things. I've seen charges to Kalahari Resort. Potentially, well, they wanted to write it off as a business expense, but the entire family went. So sometimes we have to be willing to have these really difficult conversations with our clients to let them know that these things cannot be done. It's not in alignment with the integrity of accounting. So then we know we have the cash flow statement. This is obviously one of the most important statements, because sometimes clients, as mentioned earlier, they don't necessarily understand, well, I'm making $100,000 in net income, but the bank account is telling me something different. Profit is not cash. And as tax professionals, we have to continually keep, letting our business clients know this, because especially the business clients that do not pay estimated taxes. This ties right back to bookkeeping. How can a client pay estimated taxes if they don't know what the numbers are, right? They'll be overpaying. I had a client last year. She ended up getting a refund of over $10,000 because she overpaid in estimated taxes. That $10,000 could have been used strategically during the tax year, but unfortunately, she was using the wrong information to pay those estimated taxes. So with the cash flows, we know the business can show strong net income. We already understand that, but profit is not cash. So these are the questions that we can start to ask. Is the business actually even generating cash from operations? We know our cash flow, we break it out: operating, investing, financing. This is the opportunity to do a deep dive with the client. How many of you actually do things like this at the moment with your clients, where you take a deep dive looking at the financials and you walk them through what can potentially be done or not be done? All right. And if that's you, you can put a me in the chat. Okay, perfect. All right. So we have a few yes, I do's in the chat. So the goal is for those of you that are not currently doing these things, or for those of you that are doing them, hopefully by the end of the session, there'll be something that you can walk away with, a different approach or a different mindset, different questions to ask. So where is the cash going and why? Sometimes cash is leaving the business for a legitimate expense. We know that in order to make money, you have to spend money. However, sometimes the cash is going to the client's pocket. Sometimes the cash is leaving the business and the client doesn't even really understand why. Sure, for many of us, sometimes we have subscriptions that we forgot to delete or deactivate. There are, other people that might have had access to our cards, all of these things. So that's why it's very important to start checking to see where's the cash going and why. And also, does the cash position reconcile to what the owner is telling you? Because sometimes the owners, they can tell us one thing, but I believe it was Jay-Z or someone who once said, men lie, women lie, but numbers don't. That's another reason I love math for the most part, because, the numbers for the most part are technically absolute. 5, take away 5 is always going to be 0. You cannot change that. So you always want to just ensure, one, first and foremost, is your client reliable, not just the data that they are providing you with. So as we know, none of these statements can be separated. They're symbiotic. The income statement, that's our starting point. We have our net income that flows to our balance sheet. And then we have our cash flow statement. When I think about the financial statements, I think of it like making macaroni and cheese, right? I love food, but there have been times where I've had macaroni and cheese that did not taste great. Didn't taste good, right? Maybe the shells were a little too hard. The cheese was it wasn't too cheesy. But when we think about a really good macaroni and cheese meal, typically what does the individual need to do first? They don't just start mixing, the sauces with the hard shells. You have to boil the shells first. Then from there, you start to, depending on how you make it, right, mix up the shells with the sauce and then you bake it. You cannot prepare a balance sheet without first looking at the income statement, looking at the statement of stockholders' equity. There's a process that must be followed. Cannot skip them, as you guys know. Another thing that I see sometimes in the profession, the accrual versus the cash basis method of accounting. So it's not necessarily which method is better, but it's, do we understand the method behind the numbers we're reviewing? This is a great opportunity. Typically if we're dealing with a client that's starting out, a brand new business, helping them to understand this, because sometimes clients, they don't really understand it. Also helping them to understand that maybe you're hybrid. Maybe you typically don't offer credit, but there might be situations, we're in the world of taxation where typically we'll file the tax return and we receive the payment after, right? But I'm learning now as we grow, as I'm growing as a professional, get paid first for our hard work, all right? You typically, when you go to buy food, depending on where you go, you have to pay first. Same thing, pay first and then provide the service after, all right? And then in addition to that, we also need to account for, are the books going to be maintained this way for tax purposes as well? Because sometimes you'll see a nuance. The individual, maybe they're filing it using a different method for whatever reason. But it's very important for us to understand the difference between the two from a tax planning perspective, we can now position the client in the right way. Cash basis, we know we only record it when there's an exchange of cash. Accrual basis, now we know that things look a little different depending on obviously the situation. Yes, they didn't receive the cash until January. However, the service was performed in December. So, well, based on the rules, they have to report it for that specific tax year. So walking clients through these things, so that way, if this client knows this, they might decide, hey, you know what? Let's hold off on this contract until next year. So this is the value that you provide to your clients, not just about walking them through, the accounting terminology, but even just the different methods that can ultimately be used as they're growing their business. So we have another question. It states, a business shows solid net income, but a shrinking cash position. What should the tax professional recognize? A, the income statement is likely misstated. B, profit on paper and cash in the bank is not the same thing. The gap is worth investigating. C, the business is automatically underreporting expenses. Or D, there's no follow-up necessary. All right, perfect. B, as we just pointed out, right? Profit on paper is not equivalent to cash. So these are the things, and just having that clear understanding, because sometimes, again, clients, they don't understand it. And here's the thing. Sometimes as professionals, we know this information, but how many of us actively, proactively share this information with our clients? Sometimes we see these things happening, but we don't always necessarily initiate the conversation to inform the client of what's happening in the business and what can be done to potentially save it. So we have this quick scenario. There's an income statement in front of us. The revenue is up 40% year over year, but we see that the gross margin dropped 12 points and the owner compensation doubled. So these are the things that we can, start to look at. Again, it's not always just a client reaching out to you for the information, but starting to be proactive and starting to look at the financials and ask these probing questions. So as we look at this information, what story could these numbers tell us together? So when we see that revenue increase, we typically think, all right, wow, that's a really great thing. But did that equate to the growth or the improvement of the business? So think about it in our everyday life. That's like getting a new job. You get a new job and you have a higher salary. However, the cost of commuting to this job is now more expensive. So ultimately, it's like, yes, I'm making more money, but it costs me more to make more money. So ultimately, what is the overall benefit of this decision? What caused the margin deadline? Starting to look into that a bit more. How did compensation affect profitability? Did the client take too much out of the business when it could have actually been put into the business and allocated for business purposes? So the goal is not necessarily to just, diagnose what's happening in 60 seconds. Obviously, it's going to take a deeper dive, but the goal is for the mindset shift to take place. That when we start to look at the income statement, the balance sheet, that it's not necessarily just, okay, well, these are the numbers, but what questions can we start to ask? So to start connecting the numbers instead of viewing them independently ultimately. And this ties into what I wish somebody had told me. So as mentioned, in my career, when I first started off, I actually worked for an enrolled agent, and it was an amazing opportunity. I had a lot of experience, more so of a generalist when it came to individual taxation. We did business taxes, but there was someone else that really handled it. When I made it into Big Four, that's where it was like everything hit the fan, essentially, right? I realized that my accounting degree, when I started to work with business clients, especially those, I worked with real estate investment trust REITs. So these are large companies. I mean, they have millions, billions of dollars. So now the balance sheet is required to be reported. The M1 is required to be reported. So book to tax income needs to be reconciled. But I couldn't bridge the gap between the two. So what I wish someone had told me is that a balanced trial balance does not mean that the books are right. As we know, the trial balance, it helps to make sure that everything is in balance, but it can't necessarily tell me that a transaction that should have been posted to supplies expense was posted to rent expense. So the trial balance does not necessarily mean that the books are right. The tax return, it could be mathematically correct, but if it's based on the incorrect bookkeeping, the tax return that we just prepared is inaccurate. And hopefully the IRS or the state agency doesn't come knocking. A messy set of books does not necessarily mean that it's a bad client. Some people, they don't necessarily understand accounting. For some people, accounting is like a second language. But for those of us that do understand, this is the opportunity for us to be able to empower our clients, to teach them, and depending on the professional, sometimes you might not want to share too much information because you could potentially lose the client. But the reality is empowering the client, I believe, is way more important than, just doing the tax return for them or educating them as well. So that way they understand. So when the return is being filed, and it helps to build trust as well in you as a professional. Sometimes the best tax strategy begins with the accounting equation. Had I known that, right? It's very important, again, because every transaction that's going to take place in the business, it will ultimately impact the accounting equation, which ultimately is going to translate into what is or is not reported on that tax return. And then lastly, the earlier you understand a business, it's the more useful that you can be, especially when you're working in specific industries, because they have specific, niche things. If you're dealing in real estate, they have, the segregation when it comes to the assets, bundling, the depreciation and things of that nature. If you're working with a daycare, when it comes to writing off the home office and things of that nature. So the more you familiarize yourself with that industry, the type of business, the more value you can provide to the client. And this ties back to the basis, the chart of accounts. This is ultimately the map. Check those things out. So I'd implore you guys, maybe choose about 2 to 3 clients or however many you decide, and just start to look for those clients where you are actually handling the bookkeeping. Or maybe there's a new client that comes in and they want to get QuickBooks or Xero, one of these accounting software set up. This is your opportunity to set them up the right way, or for existing clients to revamp their foundation, to rebuild the foundation rather. So as we know, the chart of accounts is just the structure, it's just the listing of all of the accounts within the financial records. But this matters for taxation, because if it's designed the right way, it makes, especially with AI and importing the information, much easier. Now it takes away from the data entry. However, if it's set up incorrectly, a poorly designed chart of accounts is going to create classification problems. As mentioned earlier, there are, depending on the type of return that you're working on, as we know, some of the account titles are going to match the specific tax form. Sometimes they don't. So we also want to be wary of what we are putting in the other expense. What are we categorizing them as? Because this can also be an opportunity. Typically, when I prepare my clients' returns, I put on both my tax preparer and professional hat, but also my auditor hat. So I'll typically advise clients, I wouldn't suggest this naming. Let's switch this around, or this shouldn't be a part of other expenses. This actually ties under supplies or commission or, whatever it might be. So when it comes to Maria, we would start to look for these types of things. Are the owner's transactions clearly identified within the chart of accounts? Sometimes you'll have clients where they don't even have equity set up correctly. They're just, dumping everything into a specific account. So these are the opportunities that are at hand. And as we know, some of the common bookkeeping errors, because if the foundation is shaky, just about everything else that's built on it is eventually going to crumble. Misclassified expenses, the personal expenses, we see this oftentimes, meals, sometimes being baked in with entertainment. We know now that entertainment is no longer going to be allowed. So these are things that we need to make sure that clients understand, that they understand that certain deductions are no longer going to be allowed based on the changes that what's happening in the tax law. Owner's draw, sometimes that's going to be classified as payroll. That's a big issue, because now if you file it in the IRS, they decide to check the 941 information and they realize, wait, there was never any payroll for this company. Now that opens room to an audit because a question was not asked. So it's very important for us to start to look at these things. Unreconciled accounts, this is a big flag, starting to set standard in my practice, right? When it comes to reconciliation, making sure that these things are being done on a monthly basis. It's just like a problem in our everyday life. If you have a problem, that problem starts off small, and then it eventually becomes a bigger problem. one that sometimes can't be contained. So you want to ensure that when you're working with these clients that they're reconciling their bank accounts. There are some clients whereby they don't want you to handle the bookkeeping because they don't want to pay. But we live in this day and age where I'm learning to even be just creative, barter, right? I have some clients that I barter with. One is an esthetician. She needs assistance with bookkeeping and accounting. I like to get my face taken care of, so we barter, right? It's not just only thinking with numbers, but also recognizing if there's a way, wait, hey, I have this skill set that I can provide to this client. They have XYZ skill set that they can provide to me, and we can work together in that way. It's not always just about the transfer of money. And then lastly, we have duplicate entries. As we know, this is what reconciliation is going to help to discover. We have clients sometimes, as mentioned, when they're using those third-party processors like Square and things of that nature. Unfortunately, sometimes they don't realize that it doesn't need to be added. It needs to be matched. They don't know that. So unfortunately, what they thought they did that was correct, it's actually incorrect. So if we don't ask those probing questions and we just take what the client gave us at face value because we didn't ask the right probing questions, we can be filing an incorrect tax return and having a client overpaying taxes. So again, we're not the auditors, but we want to shift our mindset to start asking these probing questions to ensure that certain things are not missed. All right, so I know polling question 4 was just sent, but before we move further, I just want to check in to see if anyone has any questions.
No questions so far, Erinne. Thank you.
Thanks.
All right.
Let's do polling question number 5 while we have a little pause here.
Okay. Okay, all right. So we just finished with polling question number 5, and we now have the next question. A client's tax return is prepared on the cash basis, but the internal financials are kept on the accrual basis. This is best treated as an automatic error that requires amendment, a non-issue that never affects the tax reporting, a difference worth understanding and confirming early, something relevant only when the business was formed. All right, perfect. All right, thank you, Thomas, Daniel, Karen, Kimberly, correct, C, right? And again, if your background is not necessarily in accounting, how would you know the difference between the accrual basis and the business basis of accounting? The accrual basis and cash basis, of accounting. So for individuals that just strictly deal with individuals, some of these things won't come up. When we're working with a business client for Schedule C or any of the other business forms, it's going to ask that question. How are their books kept, cash or accrual basis? So for those of you that might not currently be working with business clients, definitely implore you to ensure that you just start to understand these basics and start to take courses and just understand how to bridge that gap between accounting and taxation. So as mentioned, this was where I failed in corporate America, but I look at it as a blessing in disguise, a learning opportunity for me, because now as I'm in academia, I have the opportunity to pour into my students. I will never forget one of my students, we were talking one day and it clicked. He said, I don't just want to do taxes. I want to get a better understanding. So he started taking classes to get a better understanding or to do a refresher of his accounting knowledge, because he started his own tax practice after taking 2 of my tax classes, but he was working with business clients and understood he was struggling. So for him, he was able to learn it early on, thankfully. So book to tax, bridging the gap between accounting records and the tax return that's being filed. So we know book income, this is GAAP, taxable income, that's IRS. The book income says that net income is $150,000 based on GAAP's accounting method. As we know, GAAP typically you will follow the accrual basis method of accounting depending on the business activities, and from there you'll typically recognize the revenue when it was earned, expenses when it was incurred. On a tax perspective, taxable income might be $187,000, but those aren't the only things that necessarily cause there to be differences. What about permanent differences, right? You're dealing with a corporation and they have a key life insurance policy, not deductible, right? Depreciation methods. The GAAP requires you to, use estimated useful life. IRS has a prescribed set of depreciation recovery years that are going to be allowed. These are things that if you have a clear understanding of it, because a client might say, hey, let's say with the exception of Section 179 and bonus depreciation and things of that nature, a client might say, hey, well, I just paid $20,000 for this piece of equipment. In the event that we never had these provisions in play, this individual, it would have taken them maybe about 5 to 7 years to write it off, depending on the type of equipment, right? So knowing these things, we can now help to empower our clients so they know and they understand. So those permanent, those temporary differences, elections, the accounting methods. So the important thing is that the difference between the book and the taxable income, it's not necessarily a mistake, but it's a story. And as tax professionals, we're in a position where we can understand both accounting and taxation, so we can read that story rather than just plugging in numbers to make the difference. I wish I could really understand where my mindset was when I was working in Big Four, but I know for sure that accounting and taxation, it clicked, but not to the point where I could have brought it all together. So with reconcile, these are the key things. This is reconciling action. We start off with the financial information as it was recorded. Then from there, we start to apply the applicable tax rules. But as we know, as we scale back with GAAP, we want to make sure, was the chart of accounts set up correctly? If there are third-party vendors, did we reconcile to ensure that the income is reported at gross? Did we account for the merchant fees? So all of these different things. Sometimes when we're dealing with these business clients, they incur business expenses on their personal card. But if we don't ask the question, they wouldn't know, because some clients still think, well, because I didn't pay for it from my business bank account, I can't write it off. It's not accurate, but we can advise them now, hey, especially for our clients that are set up as an LLC, we can now let them know from a liability, a legal perspective, as an LLC, you're required to have a business bank account separate, or in the event that, let's say, God forbid, something happens, the corporate veil can be pierced. I can't, tell you how many LLCs I had to share this information with them because they didn't know. They didn't know this information. So with GAAP, we start off with those financial statements as recorded. Once they have that business bank account set up, it makes things easier. So that way everything is, being funneled through just one account. We don't necessarily need to worry about funds being commingled. And then from there, we start to apply these applicable tax rules. A lot of times when we're dealing with these business clients, a lot of them, unfortunately, what happens, they don't pay in any estimated taxes. And then from there, they have these large balances that are due. If we think about, I'm forgetting his name, LG Brooks, he would love it. Why? Tax resolution cases. So this helps LG's business. But for us, I like to put myself in my client's perspective. It's not fun to have that heavy burden of owing money, right? Having that debt, like what they say, it's like the monkey hanging on your back in a sense. So if we can encourage them, hey, put aside, 25%, 30% to cover both the state as well as the IRS. But again, if we don't have the foundation in place of the bookkeeping, we cannot advise them accurately. Yes, we can use the prior year as an estimate, but I shared that example with the client who did that, and she received a refund of over $10,000. She could have used that during the year. So then from there, as we consider GAAP, we look at, the IRS's rules and the elections. Then from there, why are they different? We want to understand the timing differences, the permanent differences, and the method choices. And this ultimately would tie into, when we're working with our C corporation and our S corporations where there are those differences. And then from there, we want to account for, well, what needs to be reconciled? And from there, we'll document it, adjust it, and then explain the differences that are material to the client so that way they understand what's going on. And how does this affect the tax return? Obviously, what's reported on the financial statements, once they're accurate, that's ultimately what should be translated to the tax return. But sometimes, myself included, the first question that I asked everyone, have you ever filed a tax return that it seemed accurate, but something still felt a little off? But the goal is that we'll no longer be in those types of positions. So here we have another quick question, and it asks, book income and taxable income differ for a client this year. What's the most appropriate first step? We'll adjust the books to match the tax return, ignore the difference if the return balances, understand why the amounts differ before treating the matter as resolved. We'll investigate it only if the difference exceeds a specific dollar amount. All right, perfect. C. So sometimes, many of you here are professionals, but sometimes when you're working in a firm and you're working under someone else, sometimes you're told to do things or required to do things that might not necessarily be accurate. So I mentioned not just working for an enrolled agent, but also working for different, firms in taxation. I've seen a lot of things, right? But C is the correct answer. You want to understand, why is there even a difference? Where for those of you that are accountants, it's easy to just plug a number, put a journal entry to get everything to tie, to be able to reconcile the bank account. But the key thing is to understand, why is there even a difference? So that's the correct answer, but also the professional habit that we should always try to keep. And this is just what I wish someone had told me, part 2. So it's a $10,000 question. It's not a literal dollar amount, but it's just a professional standard. So it's about identifying any questions that could materially change the value of an engagement. So let's look for deductions assumes that we already know what the client needs, but we can reframe that question. It's the same exact question. Let's look at deductions, but now instead of stating that, we're saying, well, what happened in your business last year? That's different. Or what happened in the business this year, rather, that's different from last year. So now the client will start to divulge certain information, and then you'll realize, hey, okay, that's a deduction. Because there's a lot of times, again, many clients are afraid of the IRS. But what are we as enrolled agents? We represent taxpayers before the IRS. So we are essentially helping to bridge that gap, to let them know, hey, yes, I understand that the IRS can be pretty scary, but at the same time, the key thing is just making sure that you are, within reason of the law, and tax avoidance is not a crime. Tax evasion is, but tax avoidance, whereby we are legally using a tax law to reduce tax liability, we're all game.
Polling question number 6 is up right now.
All right. For some reason, I'm not. Oh, now I see it. All right. And make sure you pay attention. I'll give you guys a minute. All right. Okay. All right. So as a tax professional, this is one of the greatest positions for us to be in. We can decide if we want to take the client on, and we'll figure out all the nuances after. We can decide to hold back, decide, let me actually scope this engagement first before I take it on, or let me actually refer it. So I've been in all 3 buckets, just taking on a client and figuring out the issues after. And I've learned, right, that is not the best approach, because what the client says at face value is not necessarily always what it is. So I always suggest typically scoping it first. I'll never forget, and this is very recently, took on a client, an engagement to do, well, I was going to do both the bookkeeping and the tax return. But once I realized that the bookkeeping was, it was totally way off. This business, the client was in business for, I want to say, maybe 10, it was like about 7 years or so, and never reconciled in QuickBooks. So I took on the engagement before it was actually fully scoped, just going off of, the person that referred them. And it was just a massive headache. It was literally just a massive headache. And I thought back to myself, you know better. You should have scoped it first. It took, many of hours. I outsourced it to one of the bookkeepers that I used to work with, and he took on the job, but it was literally just a massive headache. And I'm pretty sure that some of you might have also been in similar positions, not just with even business clients, even individual, for tax compliance. They come, they tell you one thing, and then it's like so many other things that are involved that you didn't realize it. So not just taking it, take it. This is if maybe there's minor classification errors. This is easier when you're dealing with like an individual client, and that, they're just working a W-2 job, they don't have a business and things of that nature. But where it starts to become more, nuanced and involved, more complex, that's where we want to make sure, as we're dealing with the businesses, that we take it minor classification errors. They have supplies, but they want it as, office supplies. Certain things, you have some clients, they want certain things a certain way. So that's something simple. The accounts are reconciled for the most part. We see that the bank balance ties to, sorry, I can't take you as a all right, so I see Thomas, take a look at Quicken Info and find in payroll many things, not payroll, impossible for them to do things right. Correct. That's the standard now that I have at the firm, because some clients, they will want you to do things that are not integral, right? So now when it goes against the integrity, I'm with you, Thomas. I cannot take you as a client. There's no amount of money that you give me to permanently wear orange. I'm sorry. All right. So client A, take it again if it's minimal. And then some clients, obviously, you can look at their books and it can be very simple for the most part. But where there's more complexity, client B, this is where you want to scope it. What I actually wish I did is C, refer it to the other client. But anyhow, so scope it. There's several years of unreconciled books. Significant cleanup required. There's a conversation that needs to be had about the scope, in addition to the timeline, because the typical cleanup take about 30 days, but now this is also dependent upon the client. Do they communicate, and how fast do they communicate? And not only how fast, but do they communicate effectively? Because many of us might find ourselves in an email thread where we're asking the same question in different ways, but the answer is not coming. So now that warrants a phone call. So these are all of the things that you need to factor in, because now it's not just time spent preparing the return and looking at the books. It's also time that's being spent to do rework, to answer client questions and all of those things. And then lastly, for client C, this is where we refer it. This is where I mentioned, this is what I wish I did with the client, because this is potentially serious, unexplained activity. And to make matters worse, government funding was involved. Right? So transactions that don't reconcile, payroll issues where, payroll is being withheld from the employees, but it wasn't remitted to the state agency. So where's the money? Right? All these different things, and put possible professional liability exposure. So as mentioned, each of you right now in this role as an enrolled agent, some of you might also be certified public accountants. We worked hard to get our designation. So it's very important that clients also respect that by me signing this return, or by me taking responsibility for this bookkeeping, my name is associated with this. My professional standard is also associated with this. So in those types of situations, much like Thomas, I cannot take you as a client, we refer them. So professional competence, as I've grown and learned in my career, it includes knowing what not to do. And this is not a weakness, but it's a judgment. So we also have to assess where we are, because sometimes in our business, depending on finances, we might just take on any client just to make ends meet. That's the reality. As an entrepreneur, I've been there before. But again, it's not just about the numbers, the money that's coming in, but also about the level of integrity of the work that's being completed. And the reality is, are we really providing value to the client if we're doing things the wrong way? So that's a mindset shift that's required. So we have another quick question. So there's a prospective client, they have several years of unreconciled books, and the cleanup required goes beyond a standard tax engagement. What's the first thing we're going to do? Complete the cleanup as part of the tax engagement. Decline the client immediately. Discuss the scope, timeline, and fees before proceeding. Refer the client without reviewing the situation further. All right. I personally feel like for this one, there's no right or wrong answer. So technically it could be C. We want to discuss the scope, the timeline, and the fees before we actually proceed. In my experience, and some of you might be able to relate, there were clients where I completed the cleanup as a part of the tax engagement. So sometimes the issue with that is that it can cause confusion for the client, because sometimes some clients don't understand, again, the difference between compliance related work, bookkeeping, and accounting. It's not all the same thing. So sometimes that can be a disservice to the client that we're not making that clear. Decline the client immediately. Sometimes you have to do that. If you understand what your current capacity is, if you realize this is probably going to take a lot more work, you can decline the client immediately. C, typically this is the best approach. You want to discuss the scope. figure out if this is going to be worthwhile before you actually proceed. And sometimes this is the best position, as many of you chose C, reason being because now you can see if a client is actually committed. There's been times in my career where I did the work, started to, clean up the books, not even as part of the tax engagement, just cleaning up the books and doing this really deep dive, only for the client not to decide to move forward, or once the price is quoted of what it's going to take for it to actually be fixed, they ghost or they decline the engagement. So with C, definitely always, do a high level review. And in D, you can just decide to refer the client to someone else. And obviously I would do that within reason, because if I see that there's a problem with this client, I would not refer it to a trusted colleague. I would, just make a general reference of, hey, there are other accountants in New York or whatever the state is that the client lives in. So here we move on to the last section, tax planning. So again, this is where we transition from compliance to strategy. And I believe that as we serve business clients, this is where the real value ultimately lives. Because as we know, with individual tax, there are some meaningful planning opportunities depending on their situation. Maybe they are a small business owner, so they kind of, tie in to a hybrid or a dual worker. They're both a W-2 employee, but also self-employed. Maybe they have some RSUs, some stock that they potentially want to sell, things of that nature. So not to say that there's never any opportunities when it comes to individual taxation, but they're limited for the most part. Now, when we get to business clients, that's where we have a great playing field. So there's a broader planning canvas. We can instruct them or advise them when it comes to entity structure. Should they be an LLC? And if they are an LLC, should they make an election to be treated as an S Corp or a C Corp? All of these different things that we can really start to walk clients through. And again, it's not waiting for the clients to come to us. If you have a client that has an LLC and they're filing a Schedule C, and you see that there's potentially a meaningful opportunity for them to be treated as an S corporation or even a C corporation, depending on their situation, it's about shifting the mindset for you not to wait for that client to come to you, but for you to share with them, hey, as I was reviewing your books, based on last year, if you were an S corporation or a C corporation, this is how much you can save. Compensation timing, retirement benefits, all of these things are opportunities for you to be able to serve your clients, but that's only if you understand the financial picture. Because if you don't understand the numbers, you run the risk of potentially giving the client inaccurate advice. And then now that trust is broken, maybe you lose the client. And unfortunately, if they make that decision, let's say a client decided to, purchase a vehicle based on your advice, or put money into some type of IRA or something of that nature. You use the wrong information, therefore they're not making the right decision. And as I'm sure some of you know, with this business tax planning canvas, the entity, as we mentioned, which one makes the most sense? Because unfortunately, some people don't understand the difference. And we live in this social media day and age where there's so many lies that's online. I can't express enough how many times people have come to me, oh, I'm going to set up an LLC because it'll save me on taxes. And I'm like, that's not the truth, but they see information online. And sometimes, even if it's a whole lot of truth, if there's a little bit of a lie, it's still a lie. So as trusted professionals, we can now advise them the right way, right? And I'm not going to lie and say that this was an area that I was always 100% sharp on. So as you prepare to start to serve your business clients, if there's an area where you're not necessarily sharp, I don't believe in only working on your strengths. Right? I believe in also sharpening your weaknesses. So I started to take courses and, reach out to colleagues and get a better understanding. So you might find yourself thinking, I don't know any of this. I don't want to, put myself in uncharted territory. I'm pretty sure that each of us on this line, if not just one time in our career, we took on a client that we were not fully prepared to handle. We had to learn along the way, in a sense. And even in taxation, some of us, we had to pivot because when Tax Cuts and Jobs Act came out, we were all like, wait, what needs to be done? the one big beautiful bill came out, we had to figure out how do we handle tips and all of these things. So don't allow yourself to feel as though you can't step into this role. And how I start to look at it from a business tax planning perspective, as a tax professional, we kind of can serve the client in a sense once we understand the numbers, in like a CFO role in a sense, right? We can look at the numbers and help them get a better understanding of what's actually happening and what can be done for them to start to generate more revenue. But how can we start to look at those KPIs? We need to understand accounting and the financial statements. All right, so in addition to entity, also the timing of certain decisions. I have clients, sometimes they'll say, hey, I'm thinking about purchasing XYZ or hiring someone or doing this. The timing matters. So it's very important because, as we know, certain deductions are not allowed once December 31st, 11:59 hits. So we let them know that. Certain things like, okay, if they want to invest in SEP and stuff like that. So you can let them know, hey, yes, December 31st, 2026 has ended. However, use the next 4 months, save up. We're going to put money into a SEP by April 15th. The client is happy, right? They can potentially save money. Benefits, depreciation, them purchasing assets, the accounting method that they decide to choose. What is the compensation going to be? This is a great opportunity when you're working with an S corporation client, trying to get them to understand the nuance of being an S corporation and making sure that the client is on payroll. That's something that I also see. Clients, they're running an S corporation. Had one client, she had an S corporation and she was working with a firm and they just made her issue a 1099, which was inaccurate, right? So these are the opportunities where either we are standing in the gap as a new tax professional, or even if we have a client and we haven't been doing things the right way, this is the time for us to fix it. Retirement, capital investment, or, trying to help make sure that their books are in the right way, or their books are accurate rather, so that way they can go to the bank. Maybe they can go to, these angel investors and present and pitch their idea. Distributions, how are they taking the money out, and is it being taken out the right way? Because again, we want to make sure that when we are dealing with these clients, that we understand their business structure, because we know that if you're an LLC versus if you're an S corp, not just the taxation is handled different, but even the accounting is handled differently. Some clients, they're not aware of that. And then lastly, the cash flow. So all of these different opportunities, and there's so many more, but these are some of the main opportunities that we have when we are working with our business clients. But the reality of it rather is, can we have any of these conversations if we don't know the number? The answer is no, right? So we can provide generalizations for the most part, but for a client to actually make a financial decision, it would be best for them to really understand what's happening at the foundation. So here we have Maria. We have this client, and she comes to us and she says, I've got $40,000 in the business. What should I do before year end? So this is the moment that the engagement changes. This is where Maria is realizing, hey, business is, going really well. Now I want to make sure that I'm doing the right thing. So in this case, what should I do before year end? What are some suggestions that you guys would provide to Maria? She's a small business owner. She has this consulting business, and let's just say she's a LLC. Single member. Okay, perfect. All right, perfect. So we're all along the same lines. All right, Maria, based on the situation, this is what you can do. You can put money into a SEP IRA, right? 401k. Hey, what if she needs to purchase any new equipment? Are there any conferences coming up next year? Obviously, on the cash basis, are there any conferences, any travel, right? Any necessary business expenses that you can pay for at the moment to legally reduce your tax liability. So now we move from just compliance, right? Where it's, okay, great. There's 400,000, and we'll just assume that this 400,000 equates to the net income. There's $400,000 of net income. We file the Schedule C, or if she were a partnership, 1065, whatever it is, we file the return. But now we transition and we want to plan what can happen next, not just follow the return as is. We start to let Maria know there's actually more that you can potentially do, as everyone started to share. Purchase that new truck, that equipment, start to save for retirement. That's also another very, very big thing that we'll realize for business owners, especially small business owners. Some of them, they're working so hard, but they don't even have a retirement plan set up. This is the value that we can provide as an advisor, and start to really sit them down and help them to realize that, hey, you're going to get older. That's, if you're not getting older, you're expired. You're going to expire, right? That's just the reality of it. So the key thing is helping them to start thinking the same way that the goal is for us to start transforming our mindset from just compliance, what happened, but what could happen next. Start to, shift the mindset of our clients to start thinking about retirement, right? If they're a business owner, and especially if they're not working a W-2 job, we want to make sure that these are the conversations that we start to have with them. And especially S corporation owners. Most people, why do they want to set up an S corporation? So that way they can save on payroll taxes. But guess what? When it's time for you to take out your Social Security, because your W-2 income was so low, you don't have a lot saved up for Social Security income when you retire. They're not thinking about that sometimes. So these are the opportunities that we have at hand, where we can help our clients to start planning what can happen next. And then advisory, we're now giving that advice. This is what you should consider. Present that information to them, and then now obviously it's up to the client to make the final decision.
Polling question number 7 is up now.
All right, so I'll give you guys a minute to answer that. All right, so perfect. Thank you, Michael. So client has significant cash sitting in a business. What should we do with it? So again, this is tying into Maria. Maybe now it's not just a client coming with 400,000. If we really start to master and understand this information, now the clients that have millions, right, start to come in. Just from having the understanding of this information, because I know we might sometimes look at the numbers like, wow, that's a really large number, millions and billions. One of the key things that I love about accounting is that the fundamentals stay the same. Ultimately stays the same. So therefore, we're still in a position whereby we can advise this client because we have the understanding of how the number works. So C, that's what we will want to do. We don't recommend them just, going to purchase a car and equipment and all of those things, because we also want to preserve cash flow. So we want to reduce their tax liability, but we also want to preserve their cash flow. So we can look at it from a lot of different angles as we're starting to, serve these clients and ensure that they understand what they should do as cash is sitting in the business. So we analyze the business facts, and then what's the potential tax consequences before they actually make that recommendation. So if we think about Maria, we might decide, it might be one of those one-off situations where maybe we do, elect to be an S corporation when we start the new tax year. So these are the conversations that we can start to have with clients. And this is essentially, it's just putting it all together. So here we have this client, and it is an S corporation. So we have a business profile. It's an S corporation. It's a professional services firm. It's year 4 of their operations. It's owner operated, and there's 2 part-time employees. And these are our numbers. So the revenue was $628,000. We see that it was up $28,000 from the prior year. We have net book income of $95,000, shareholders distribution of $180,000, and there were loans to shareholders of $45,000. And we see a few things as we observe what's happening. So accounts receivable aged significantly. That could be a problem, right? Because we see revenue of $620,000, but how much of that is actually outstanding? You see fixed assets added mid-year, but there's no documentation for it. So it's a possibility that a eligible, legitimate expense could be missed if that's not captured. And then there's 2 months of bank statements that are missing from the reconciliation. So if we start to look at these facts together, the first question is not necessarily, where do I put this information on the return? Because it could be easy to just input the 620,000, input all of the expenses, etc. But it's not where do I put this information on the return? Do I understand and do I trust this financial picture well enough to actually start to work on this return? So this is where we start to ask those questions. So we work through this as a professional, which we are. What do we see? What concerns me? What questions am I going to start to ask? All right. So we see, yes, revenue increased. The same example that we gave earlier. You make more money at this new job, but it costs you more to commute. So there was an increase of 28% of revenue. What about expenses? Did they break even? Did they end up spending more money that they actually started to bring into the company? So this is the value that you bring. These are the questions that you can start to ask. I'm not sure if you guys ever saw, this is Planet Popcorn. It was a company whereby there was this guy, he was like an entrepreneur and he helped struggling businesses. And sometimes that's the challenge. An individual, they start a business, but then they have so many ideas and they don't realize that the second idea that they're bringing into the business is actually costing them money versus bringing in money. So as you see these things, you start to ask those probing questions. 2, now you figure out, all right, well, what needs investigation? Why is accounts receivable aging so significantly? What is the company's process for collecting accounts receivable? These are the things that we start to look into. Or what book to tax differences might exist depending on the company. What could affect the return, right? We looked on the previous slide of all of the different tax planning opportunities. Maybe we start to discuss retirement. Maybe we discuss entity structuring, timing, right? All of these different things, there are opportunities that exist, and we don't just want to wait for the client to ask us about them. We want to be proactive, because the reality is, guess what? For a lack of a better word, there are poachers out there. And sometimes what we're not giving to our clients, someone else will reach out to them and give it to them, right? They'll say, hey, has your tax professional or tax accountant taken the time to explain to you some of the deductions that you can take for the tax year? And they'll say, no, my tax accountant doesn't do that. But because they don't understand always the difference between compliance and tax planning, they'll think that you're being a bad tax professional. So I just want to implore you to take the time to, again, be proactive and start to look at your book of business clients and see which clients you can start to work with. And then lastly, what's your decision? Now you decide, are you going to prepare it? Are you going to clean up the books? Are you going to scope any additional services? Because it's like, let's say you hire somebody to come and clean your house. Your house looks nice. It looks pristine. However, you personally, you don't know how to steward your space well. So even though your space looks really nice right now, give it a few days, maybe a week, the house is going to end up in the exact same position. So when you're cleaning the books for clients, it's also to recommend, is there going to be some ongoing bookkeeping that's going to be done to make sure that we cleaned up the books and it's going to be maintained? So as we look at this specific situation that we just saw, this is applying the method that I mentioned earlier, the reconcile method. So we're going to walk through the framework with the case that we saw. So we're going to read it. So we see that revenue was up 620,000, or revenue is rather 620,000. It was up 28%. But we see that the net book income is only 95,000. The distributions of 180,000 exceeded the reported income. At this point, something is not adding up. So we're reading the numbers. Now from there, we're going to question it. What's not making sense at this point? So why are $45,000 in shareholder loan on the books? And one, we're dealing with an S corporation. So as many of us know, when we're dealing with an S corporation, it's not necessarily like an LLC where you can just put money in and take money out of the corporation as you see fit for the most part. When we're dealing with an S corporation, there needs to be some type of documentation in place when it comes to being reimbursed for personal expenses and all of those things. So when we're dealing with S corporations, we're sort of like in a new territory when it comes to the accounting and things that need to be done. So why are the fixed assets undocumented? What is the process? Why are 2 months of bank statements missing from the reconciliation? So these are the questions that we're going to start to ask because it doesn't necessarily make sense what's going on. We'll investigate now. Okay, 2 months of bank statements that's missing. We just need to pull that online. That's not necessarily a big issue. We'll get the documentation on the fixed assets. Maybe the invoice wasn't sent over, or the purchase order, whatever it is. We'll get that information. We clearly know that there's 2 assets. We need to know what the cost is so we can add it to the book. From there, now with this $45,000, this is where we want to dig a little deeper. Is this $45,000 actually a loan, or is it a disguised distribution? So these are the opportunities that we have as tax professionals, not just to serve clients, but also to recognize when we should potentially maybe move away from working with a client. Because some clients, again, that $45,000, it could have been a disguised distribution. So now it's up to us to take on professional judgment, ask the right questions, and then from there, we'll make an informed decision. I'm going to move forward working with this client, or I'm not going to move forward. From there, we connect it. The distributions versus the reasonable compensation. Is the shareholder taking these draws to avoid payroll tax? We know sometimes with S corporations, that's where it can become a little sticky. There have been lots of cases about that. Loan versus distribution characterization. It affects both the return as well as the shareholder's basis. So now in the event that, let's say, the S corporation has a loss, a portion of the losses are not going to be allowed, right? So it affects 2 things. Jeff, it's the last polling question.
Yep.
Okay. All right,
Very
perfect.
good.
So last polling question is up. I'll give you guys a minute. All right. So next, with identifying the retirement contribution opportunity. So now we can potentially talk them through putting money away. Accounting method review, we can also start to review that to make sure, all right, based on the nature of your business, is this best? Because if they're under the accrual basis method of accounting, revenue is going to be reported, obviously, but it doesn't necessarily mean that they have the cash in hand. So maybe it's best for them to operate according to the cash basis method, which truly reflects the money that's coming into the business. So these are the opportunities that we have. Year-end timing when it comes to the receivables, and as far as the expenses, maybe some of the receivables need to be written off, right? Maybe there are some expenses that we can incur now in hopes to reduce the tax liability legally. And then lastly, we decide if we're going to execute. We'll scope the cleanup before we actually prepare the return, before we do any work. Because again, sometimes we can jump right into the work and then maybe the client doesn't want to move forward with the engagement. Or once we start the work, we realize that the foundation is messed up and we need to fix that first. If there's any adjustments, we document that. And then from there, you schedule that conversation with the client, being proactive to let them know any year-end strategies, whether it relates to the compensation, purchasing assets, and things of that nature, or paying for expenses. All right, before we go to the next slide, anyone have any questions? In France, that was an amazing idea. I love that. So if I am allowed to return, that sounds like a really great presentation to put together.
No questions at the moment. Thank you.
Okay. All right. Thanks, Michelle. So we're wrapping up. We're in our last 20 minutes. So this is just a 10-minute business tax financial scan. So the next time that you work with one of your business clients, I just hope that you guys just, maybe just think about me. Think about this presentation and just, look at it really quickly if you're not already in this mindset. Start to take a deep dive into these things. Look at the business's revenue. Look at the gross profit, some of their major expense categories. Look at their cash or, their bank accounts, their accounts receivable, loans, all these different opportunities that we have to be proactive with our clients. So this is one of the most practical tools that you can take back to your practice. So before we ever open the tax software, start to scan this financial picture. We look at these 10 items and then realize, stop. For this business client, what doesn't make sense? And then from there, okay, what do I need to know? What's going on with the revenue, or what's going on with the fixed assets? And from there, you connect it to what the potential tax consequences are, you act. It doesn't necessarily mean every client is going to need a financial analysis. That's not what we're saying. But it does mean that we should stop treating every set of numbers equally trustworthy without actually looking at the whole story, the whole picture, right? Because again, typically with clients, if we're not doing the bookkeeping, they just give us the statement. We don't necessarily know the details. But for those clients where we are in that position, or maybe you do have a client who you just handle the tax return and they have another accountant, this can be an opportunity for you to essentially be like a, one-stop shop. Obviously, assuming you have that accounting background and you're confident in it, you can do both the bookkeeping as well as the tax return. And now, you can be more confident filing that tax return because you know that you followed the accounting principles, you understand it, and the books have been completed to the most of integrity. So therefore, we know that we're providing and serving this client in the best way possible. So in order for us to transition to that, this is the transition that I had to make. I had to transition from, just a compliance mindset. I get the tax documents, I input them, the return is done, to advisory rather, where now start wanting to be more strategic, the spectrum. So as a return preparer, the key thing, again, we just want to make sure that the information is being processed accurately and there's a correct return. Nobody wants to get an audit or a phone call from the client like, hey, I received this notice from the IRS or the state, something was missing on the return. So we want to make sure that we produce a correct return. But from there, we want to become the informed preparer. That's typically where we start off. That's where all of us, start off. We're inputting the data, we're learning the ropes of taxation. But as an informed preparer, this is where we start asking those clarifying questions. And it's simple, not even just for, business clients, even individuals. Hey, just to confirm, was ABC Corporation the only firm you worked for? No, I actually also worked for XYZ Corporation. So just by asking those probing questions, because there have been times where clients, they upload the usual documents, but then they don't remember that this 1099 was issued or other documents came in. Asking those clarifying questions, from there, we can identify issues and then flag concerns. And then as a tax professional, we know now we can read the business. We connect the accounting to the tax and we can identify those opportunities. So now again, we are serving the client, empowering them and giving them a better understanding of what the numbers mean. And then lastly, this is where we ultimately become that trusted advisor. So before that client makes a decision, obviously, you shouldn't have them on a retainer, but when they make those decisions, hey, I am considering purchasing this asset, or I'm considering working this new 1099 gig. How is it going to affect me for tax purposes? We understand the financial picture so we can help guide those business decisions. So now it's not just a April 15th or an October 15th engagement, but it's a year-round engagement where you're providing value to the client. So every practitioner in this room, we're somewhere on the spectrum and we can move further along on it. So that was the key thing that I wanted, just for us to understand in this presentation today. So for those of you that might not currently be doing these things in your practice, to start asking these questions for our business clients, to start taking a deep dive into what's happening in their financials. And maybe accounting is not your background. Maybe you're not strong in accounting. There are a plethora of courses out there that you can take. I know even QuickBooks Online has a bookkeeping principles course that's free that you can take. My uncle once told me, if you're not learning, you're not living. And even if you're 80 years old, there's something that you can learn. I believe that. Age, is not a restraint when it comes to learning. So take, what you've learned today. Hopefully, I'm trusting everyone, could have walked away with at least one thing that you can apply in your practice. So yes, compliance, it's always going to be essential. We could never get away from compliance because I don't think the IRS, I once heard that people were saying of trying to protest against having to pay taxes. I highly doubt that'll ever happen. But again, The key thing is what we build on top of it, because all individuals and businesses have to file a tax return. But as we know with businesses, we have more of an opportunity to plan. So we have 60 seconds in this final challenge. So there's one final business that we're going to look at. So there's revenue of 380,000. There's net income of 12,000, an owner's draw of 210,000, cash of 4,200, and then we have receivables of 95,000. So when we look at this, we can't necessarily make a decision. So this is what I want you guys to understand. Yes, we can look at the income statement for the client. Yes, we can look at the tax return, but ultimately it's going to require us to take that deep dive. What do we notice? What do we see? Yes, the business generated revenue. We see net income is only 12,000. So, where did $68,000 go? What were the expenses for? What's the nature of this business? Which industry are they in? Is, $368,000 worth of expenses reasonable? Because we know sometimes business owners, they don't want to pay a lot to Uncle Sam and to the state agency. So these are the things that we start to look at. Why is the cash so low? What's going on with the receivables? So these are the key things. We start to read the numbers. We're questioning what's happening because all of them are related in some way, shape, or form. And then from there, we start to investigate. So this is ultimately the framework that I want you guys to remember after today. Reading the financials, what are they telling us? Questioning what does make sense, but also what does not make sense. And then from there, we start to investigate. What do we need to verify? And we connect it to taxation. So again, that's the benefit of being not just a tax preparer, but being a tax accountant. We understand how the bookkeeping and the accounting affects taxation. So we connect the two, we're bridging that gap. From there, we identify what opportunities exist, right? Based on a position that the client is in. As a business owner, we can, let them know Section 162 of the Internal Revenue Code says you can write off whatever is ordinary, reasonable, and necessary. Because sometimes you will have clients that are scared of the IRS. I've literally had clients, that will cry. They're like, are you sure nothing is going to happen? And would literally have to, walk them through, show them the publication, let them know. No, because some people are scarred, from the IRS or have heard of, different situations with people with the IRS. But you want to let them know these are the opportunities that exist, and also show them the authoritative guidance that can make them more comfortable if you do have those clients that are a little anxious and don't necessarily, want to be aggressive, if they would call it that. All right. And then lastly, decide which action is actually appropriate for you to take. Maybe it doesn't make sense for this client to go and purchase this car or this equipment right now, because yes, net income is this, but cash flow is showing us this. And we want to make sure that they have enough cash to fund their normal course of operations. And then lastly, from there, you execute. We prepare what needs to be prepared, adjust, investigate, plan, scope, or refer based on all of the prior steps that we did. So what I would like for each of you to take with you is the tools, the mindset, and the next step in your practice. So again, for there to be a professional mindset shift, not just a compliance mindset, what did the return require? Is the information accurate? Is it correct? And if it is, we file it out and then, wash, rinse, repeat. Next client, we'll see the next client. We'll see the same client rather next year when it's the next tax season. But from the advisory mindset, what does the business need? And can I offer it to them? Or is there anything that I can identify that the business needs that they're not aware of? What does the data reveal? As we're looking at the financials, we want to start to understand, okay, what's going on with accounts receivable, accounts payable, all of these different things. As we start to take that deep dive, now we're being proactive with the way we serve our clients. And what conversation should you be having with the client? So we know compliance is the foundation, but understanding the business is what you're ultimately building on top of it. So these are just a few key takeaways. The return, as we know, that's the rear view mirror. It's done on a retroactive basis. The financials are the windshield. We're looking forward to see what can be done for this business client. So as you have those conversations with your business clients, you want to use both prior year's tax return, and we also start looking forward. So for those business clients that you might already start thinking about, have started thinking about, make sure, obviously, have they kept the books for the last 7 months? And if not, this is a great opportunity for you to potentially, again, obviously, if you have the accounting background or the knowledge, or maybe you have a bookkeeper on staff that can handle it, that can be a potential way for you to start bringing in clients. Book income, as we know, does not always equate to taxable income. This was my Big Four story. And again, the reason for this workshop, one of the reasons why I work so hard on my weaknesses to figure out, okay, if I don't understand something, let me look at some workshops or do some reading, so that way as a professional become well versed. So there's certain things within the profession that you learn sometimes from experience, you learn sometimes from training. Book income and taxable income are sometimes not always equal. The difference is going to tell that story. Learn to read it. So if in the profession, let's say, or in your practice rather, you're working with a client and you come across a scenario or a situation that you're not familiar with, again, don't run away from it. Use it as an opportunity to grow. Accounting fluency is not the destination. It's a foundation in order to have better tax conversations. Professional competence includes not just knowing what to do, but also what not to do. I'm pretty sure, again, none of us in here want to permanently wear orange. So it's very important for us to really assess, should I take this client? Before I take them, I'm going to actually scope it to make sure that I have the capacity to take on this client. Or lastly, you might decide, I'm just going to refer this client. Don't want to, take them on. And then lastly, that $10,000 question that's ultimately going to change that engagement. Imagine how happy a client is going to be where, when you come to them and say, hey, I've been assessing your books and I see a potential opportunity where you can save $1,000 in taxes. Right? This client is going to be, they're going to be intrigued. Who doesn't want to save money, right? In this day and age with gas prices being astronomical, every dollar counts. So this is the opportunity for you to, again, have that professional mindset shift and start asking your clients the right questions proactively. So what I wish someone had told me, final insight, again, you don't necessarily have to become an accountant, because there are, some students and some people that I've met that have taken the enrolled agent designation. And that's one of the great things about the enrolled agent designation, that it prevents that barrier to entry. Not everybody can afford to get a 4-year degree and to go get a master's and then pay for the CPA exam, which is, expensive, and then also pay for the study material. With the enrolled agent designation, the fact that it, opens that door for you. But the key thing, again, is that when you start working with those business clients, having the understanding of accounting, that is the game changer. So you don't necessarily need an accountant degree, but having that accounting, fundamentals, that foundation, it definitely makes a difference when you're working with business clients. So again, you don't have to become an accountant, but you have to become better at reading the business and understanding the numbers. Because the better you understand the numbers, the better questions you're going to ask. And the better questions you ask, the better tax decisions you can help your tax client to make. And ultimately, the better tax professional you become. And what happens typically, I'm pretty sure for each of you in your practice, you've received referrals because clients, they trust you. They recognize that you know what you're doing. And now for those of you that might not have been doing it or, are already doing it, we can take it up a notch. And now we can be more proactive and reach out to our clients first with information and let them know what we find out and how we can help them. And I'm pretty sure, ultimately more referrals will just come naturally as the business grows. All right. So this is our last slide, just talking about some of the practical tools that we've covered today. So we have the reconcile method again. We're going to read the numbers. We're going to question what makes sense, what doesn't. We're going to investigate, connect. Again, this is where we're bridging the gap. It's not just that we're handling the accounting, but we're translating the accounting data to the tax return that we're going to prepare. We're going to identify any opportunities, decide on which opportunities we're going to move forward, and then you and the client will execute it. And I believe that this can be applied to every business client. That's what I believe. And we have this 10-minute financial scan. It's 10 items, 4 actions, right? This is just a structured way to figure out what's going on with the business. We can start to look at revenue, gross margin. We can start to look at the assets, all of these different things to see what's ultimately happening in this business so we can make the right decision. And then lastly, that $10,000 question, because sometimes we jump right to the solution. Sometimes before actually, you know, that was me with that engagement that I mentioned, where the books were never reconciled, and, you know, just based off of the referral, yeah, let me just help out. Jumped right into the books, and it was a holy nightmare. So before jumping to the solution, you want to find the questions that can materially change the quality of the engagement. If certain questions were asked up front, I would have known very well what I would have been getting gotten myself into, and probably would not have taken it on. So lastly, again, take it, scope it. I definitely agree that should be, or encourage you to try to always make that the first step, to scope it, because what the client tells you is not always the full picture of their situation. So take it, scope it, and refer it. And this is a professional judgment framework for every cleanup when you're dealing with accounting, and even just any tax engagement decisions that you need to make. Take it, scope it, refer it. All right, and that brings us to the end of our presentation for today. Again, it's Reconcile, just trying to connect accounting, tax, and business strategies, because I believe once you read the business and understand the numbers, you can connect tax and create meaningful opportunities for your clients.
Erinne, oh my gosh. I did not know what I was in for this evening, but let me tell you, this was clearly a great eye-opener, and no one on this presentation can say that they didn't learn something new. Or even if we're doing all those things, what you've done is reinforce the things that we know we should be doing, so we're doing the right things. Or even if we're doing the right things, maybe there's a different way to approach it. This was amazing. And you know, sometimes we as preparers want to please our clients, but what we miss is, in trying to please them, we sort of put blinders on, and we don't dig, and we don't ask the right questions. And that happens especially with new clients, because I've had cases where I get new client, the accountants for years have been doing X, Y, and Z, and here I come saying, oh, no, wrong. And they're like, but it's been done like this for years. So how do you come to that client and say, and I've never been audited, you know? So then when you have a situation like that where it says it's been done like that for the years, they've never been audited, and you're saying, hey, this is all wrong, you look like the bad guy, right? But also, one of the things I try to hit home to clients is, when I see these numbers not making sense, I say, well, let's talk about how you're living. Because you're telling me you made no money. Let's look at how much rent you're paying, how you're living. What you're telling me your net is, could you have lived on that? Is it possible? Because the IRS looks at all those things, the neighborhood you're living in and all that. So it's not just what you see is necessarily, we know what you see is not what you necessarily get. So you definitely have to dig deeper. So I loved it. Thank you so much. So much. Really appreciated this.
All right, thank you all for having me. I definitely appreciate it.
Thank you, Erinne. This was really, really, really great. And I haven't seen the evaluations, but so much positive feedback coming in and in the chat. And bring Erinne back, and we will follow that instruction. So I just wanted to also thank everyone for attending. And don't forget, we've got webinars coming up. We've got Frank Deegan coming back on September 16th. We've got, of course, our annual conference in Saratoga Springs, October 25th to 27th. And before that, at our annual meeting, which will be virtual, we'll have a special treat of Matt Metris presenting the latest and greatest on Form 1099-DA for digital assets. We've got Larry Pon doing a 3-hour presentation on Social Security and IRMA issues for tax pros. That's on November 18th. And then we'll welcome another debut artist, Michael Miranda, on December 9th for retirement distributions after the Secure Act 1.0 and 2.0. And then finally in January 27, we'll have Frank Deegan and Catherine Keene back for our traditional federal and New York tax update webinars. That'll be Frank on January 6th and Catherine on January 20th. And thanks again, everyone. Thank you, Erinne. Thank you, our wrangling team. And we'll see you all next time.
Thank you,
And don't
everyone.
forget, next month, September 24th, is our mixer. And you know what? You look, you never know. Erinne will be on and you can continue this conversation, ask her questions. You never know what you're going to get at our next mixer, September 24th at 6 p.m. Join us, please. Have a wonderful night, everybody.
That
Good
was
night,
a
everyone.
great thing. I agree.
Yes, it was amazing.